Well, thank you for joining us for today's webinar, Estate Planning Tips and Tax Considerations. This is the first of a special series on estate planning in partnership with the UAB Office of Planned Giving. I'm Greg Berry, Assistant Director in the UAB Office of Alumni Affairs. Just a quick disclaimer, since this is a virtual discussion, please don't be surprised if you hear or see things that may seem out of place, or even if you notice any technical glitches. I do want to ask that everybody, if you can, change your name on Zoom so we can better identify our guests. Just go to your name on the participants list, click more, and then enter your name. You can rename yourself there. Also, in order to be mindful of our guests, please remain muted. So this afternoon, we will be taking a look at the key factors to consider when putting an estate plan in place. Before we introduce our guests, I would like to ask a quick question. So the question is, where are you in your estate planning process? Go ahead and submit one of these three answers. So are you just beginning to create your plan, or maybe you have one, you're just not sure if it works anymore? And then lastly, the final option for those have one in place and they're confident in it. I'll go ahead and keep the poll up for a few moments so you can submit your answers. After today's presentation, we will have time to ask your questions, so please submit them through the chat box. And here are the results of today's poll. Share those with you. It's a majority of you are just beginning the estate planning process. 60% of you say you are just beginning, 27% have a plan, they're just not sure if it works, and 12% of you, 9 of you, you're pretty confident in your plan currently. So thank you so much for taking part in today's survey. Now at this time, I would like Kimberly Kopic, Director of Development for the UAB Office of Planned Giving, to introduce today's guest. Kimberly.
Thank you, Greg, and good afternoon, everyone. Again, my name is Kimberly Kopic, and I am the Director of Planned Giving at UAB. It is my great pleasure this afternoon to introduce Sheri Robinson, our featured speaker. Sheri received her Bachelor of Science in Accounting from UAB. From that solid educational foundation, she's amassed more than 25 years of experience as a financial planner, serving in positions such as Director of Financial Planning at the Welch Group, Senior Financial Planning at Charles D. Haynes, LLC, Senior Vice President, Financial Planning Group at AmSouth, Wealth Strategist, BBVA Wealth Solutions. Sheri is currently working as an Executive Vice President, Wealth Advisor at Linscomb Williams, where she helps guide clients through comprehensive financial planning. She's the recipient of UAB's Top 25 Excellence in Business Award in both 2017 and 2018, and she serves on the UAB National Alumni Society Board of Directors. Sheri, thank you so much for being here with us today, and without any further ado, I'm going to turn it over to you.
Thank you, Kimberly. And thanks everyone for attending. It's a great number of participants, so I'm glad people are interested in this topic, and I hope to have something that is valuable to share with you in the next hour. Everyone's situation is different, obviously. You have different objectives and situations, but I think you'll find some things valuable here. I really enjoy this topic, and I'm glad to share what I know with you. And I think where my unique expertise comes in is helping to bridge the technical of estate planning to clients' goals and objectives in their personal family situation. So as Greg said, we'll have some time for questions afterwards. So look forward to your challenging questions, and we'll get started. But what I want to cover today, this is an overview of what I hope to get through today in the time that we have, is to go through some key financial figures that relate to estate planning and gift planning, talk about some important concepts in estate planning, essential things that you need to have, decision makers, the core documents. And then we're going to jump into the weeds a little bit, and we're going to look at a traditional planning structure of how you pull together some of these concepts and how that traditional plan might look. And then we'll dive a little deeper and we'll layer on some advanced charitable strategies. So that's my goal today. So let's dive in and see what we can get through all of this. the key figures that I want to talk about. First of all, the annual exclusion for gifts. Oh, wait, before I say that, the number one thing to keep in mind is that Congress giveth and Congress taketh away. So these rules change all the time. So if you do have a great plan in place, as a few of you said, or some of you said you feel like your plan may be out of date, there's a reason for that. It's because the rules change on you all the time. So it's something that's important to go back and review your plan. And these numbers change all the time. The annual exclusion gift right now, $15,000 per person. That's the amount that you can give away to somebody and not pay any gift tax and not have to file a gift tax return. People usually limit this to family members, but you can actually give the $15,000 to anybody you want. They do not have to be a relative. Again, we do tend to favor our relatives in the planning world. So that typically will go to children, grandchildren. And if you're married, you and your spouse can each give $15,000. So at first glance, it doesn't sound like a very powerful technique, but if you have a large family and you're trying to move a lot of cash or assets outside of your estate for estate planning reasons, it can really add up. If you just think about if you have two children and they're both married and they have children, you have grandchildren, between you and your spouse, if you're married, you can give each one of those people $30,000 every year. So you can funnel a lot of money out of an estate with this strategy. A lot of people have concerns about giving people that much money, but obviously you can do that in trust, but that's a great technique. The next one on the list is one that not very many people know about or use, but it is a fabulous way. Again, if your goal is you have a taxable estate and you're trying to move money out of your estate, making gifts for education or medical expenses, if done properly, can be a way to move money out of your estate, and it's not considered an annual exclusion gift or a taxable gift in any way. One of my favorite examples out of my career, and this was a long time ago, had a grandmother with a taxable estate, and she wanted to pay for her granddaughter's education. So she was planning on writing the check for that. Problem was she was in her 90s and we didn't know how long she was going to live. So we contacted the university where her granddaughter was going and arranged to pay for 4 years of college in advance, just in case she wasn't there to write the check. None of that was a taxable gift. And so it's a great strategy to use. You can do the same thing with medical expenses. It's a little bit more cumbersome because it has to be done at that point of sale. When you're making a copayment, when you're paying a bill, it can't be reimbursed. So there are some ways you can do that to make it a little easier. But again, it's a great way when I have clients that, again, have that large family, large amount of grandchildren, and they're wanting to help pay for braces and out-of-pocket medical and all of that stuff. This can be a great way to help your family members while you're alive, and it's not even part of your annual exclusion. The unlimited marital deduction, that's been around forever. It's really kind of a catch-all that if you're married, no matter what you leave to your spouse, there's no estate tax at that first death. It's really a deferral strategy because eventually the tax man knocks on the door. But it's definitely a technique we use to defer taxes. The gift and estate tax exemption, boy, has this changed a lot in my career. When I started in planning in the 90s, the exemption was $600,000 per person. So literally everybody I met, even I, pretty early in my life, had an estate tax problem. But this number has changed a lot over the years. This is from the recent Tax Cuts and Jobs Acts from 2017 that increased the gift and estate tax exemption to a very large amount, and it indexes every year for inflation. And for 2020, it's at $11.5 million per person. So a married couple can have almost a $23 million estate before they have to worry about estate taxes. Estate taxes are not the only thing to worry about. That does not mean planning is dead. Planning is as important as ever. And again, Congress could change this at any time. This law is set to sunset in 2026. It would revert back to the 2017 levels plus an adjustment for inflation. So it wouldn't go back to nothing, but you know, one thing you can probably count on is that we'll see a change in the rule before then. The maximum gift and estate tax rate was brought down to just a flat 40% for anybody having a taxable estate over those exemption amounts. And again, that is down from when I started, I think it was at 55%. Generation skipping tax, again, this is something that you can use in conjunction with doing your using your estate and gift exemption. It is now coupled with that amount. It's the same dollar amount. It isn't always coupled in the same amount. We'll get into this a little bit later. It's a great provision to use with large estates. Gives some asset protection to trust that you create. Okay, and again, that tax rate's 40%. We typically avoid that with good planning. All right, let's look at the next slide. Some important things to understand when you're looking at estate planning. It's obviously very important to have a will, but a will doesn't control everything in your estate. This is a big area that I see where people make mistakes. It's not understanding that the will is not going to control something that through how an account is titled or how a beneficiary designation will take precedence. So if you own property joint with right of survivorship, that's not controlled under your will. That's going to be controlled by title. If you have a life insurance policy or a retirement plan and you name a beneficiary, obviously your will doesn't control that. So it takes a lot of coordination to make sure that your entire estate flows the way you want it to, by really looking at those things. And trust accounts that you set up or a beneficiary of would flow outside of your estate as well. So those are important things to look at. A really important concept in estate planning that has only been around since 2010, since the 2010 Tax Act, is a concept called portability. This makes estate planning so much simpler. And by that, I mean, prior to having portability, when you when a spouse has an estate tax exemption, when each spouse has that, if the first one dies and doesn't use that exemption, prior to 2010, it was lost, it was wasted. And an exemption is a terrible thing to waste. I mean, that's awful. And you know, so we always try and avoid that with clients. Now you've got some options on and the way we would make sure we didn't waste it in prior years was you had to separate out assets. So each spouse had assets that would be in their probate estate that they could use their exemption towards keeping those assets shielded from estate taxes. So you had to split up assets. You know, joint property, we would typically change to either tenants in common or pick and choose assets to put in the husband's name, the wife's name, so that we had, and you don't know who's going to die first. So you either had to make it even or, you know, make a guess of who was going to pass away first. Portability means that, especially for a smaller estate, you don't have to worry about that. But it's not the end all be all to rely on exclusively. There are some limitations of its usefulness, but for a small estate, it's great to not have to worry about taking assets out of joint ownership, because that's just a more comfortable place for people to be, to know that they each own the assets equally, that it's an easy transfer at the first death. You're not really worrying about, probate. But we'll go through an example later of why not relying on portability is a better option in a taxable estate or even a large estate. And then creditor protection is something that you can extend through trust in your estate plan. It's again a very important concept. And, you know, a lot of people think when they think about creditor protection, they think, oh, you know, that's I was in an accident and I was at fault and that kind of creditor. No, no. The number one creditor that we worry about in estate planning is that ex-spouse. Divorce is the biggest creditor out there. And so a lot of my clients are trying to structure their plans in anticipation of trying to protect those assets from divorce. Okay, so having a basic plan is really important, even if it's not perfect. You know, it can be very stressful kind of going through the estate planning process, and you don't know how your beneficiaries are going to turn out 20 years down the road, right? So it can be a reason to delay because you're just not really sure what the future holds. But rest assured, if you don't have a will, the state has one for you. And in Alabama, you're probably not going to like what that plan is. So we have the intestacy rules in Alabama. And basically, if you're single and you die without a will, your assets go back to your parents. That's probably fine. If you're married and you have no children, but your parents are still alive, your assets that are your probate assets would be split between your wife and your parents. That's probably not what you want. Now, if you bought a house together joint with right of survivorship, remember, title always overrules. We're talking about any separate property that's in your own name. If you are married and have children and have parents, parents don't count anymore. The children are going to take their part. So your spouse would have to split basically half the assets with your children. They may be minors. It may put your spouse's financial situation in a little riskier place, having to give up half the assets. So just to say, I always like to say that so that you do have a will. It's just probably not the one you want. So I told Kimberly this was my scare tactic to get people to get a will done. You don't want this situation. So part of a good plan is identifying important people who play important roles in your estate. So executors and trustees, how you handle an incapacity, how the assets pass. And a lot of times this is a difficult part, identifying those key decision makers and who their successors will be, can be a very difficult part. We'll talk about that more in a little bit. And then, as I said earlier, and I'm going to harp on this a lot because this is the biggest area where I see people mess up, is not really considering how their property is titled and beneficiary designation. So you absolutely have to coordinate all that. It takes a lot, and it's a part that just gets overlooked. Clients this is not their area of expertise, and it's something easy to overlook. So let's go to the next slide. We'll dig into some of those key decision makers. Here's one that's always fun to talk about with people who have young children. Who's going to raise your children? This is really personal, and it can be a very difficult decision. Some people have a lot of family members around that they would be very comfortable with. Other people don't have family nearby, or say definitely don't want them raising my children. You hear all kinds of things. But it's an important thing. And the part to keep separate here is that this is the person who would be raising your children if you and your spouse both died. Neither of you were there. And I tell clients, try and think of someone who has similar values. They don't have to have money sense. We can separate out that function. So somebody who has similar values is the key thing that I help people try and figure out there. And then the other roles are the money sense roles. So who's going to handle all the money? Who's going to get the estate through the probate process? That's the executor or personal representative. That's a temporary job. It can be a complicated job or it can be a simple job depending on the size of the estate, but it is a temporary job. But you do want someone who is good with money or can hire somebody to help with that. And the trustees, if you're creating trust, if you have minor children, and you will be creating trust at least until the children become of the age of majority. They need to be 21 in Alabama before they can receive property outright. But who would be the trustee for that trust? Now, when I'm working with clients, I'm typically advising them to take advantage of what trust can do, the incredible tax planning you can achieve by using trust, but then you do tend to have a trustee for a longer period of time. So you'd want to take that into consideration when you're thinking about that person, their age, who appropriate backups would be. And then the other thing to think about is who's going to take care of you and pay the bills and make decisions if you're not dead, but you're incapacitated and you cannot speak for yourself. So, I mean, this is a dire situation. Obviously, you're, in a coma, unable to, hold up 3 fingers or, make any kind of communication whatsoever. Who is going to handle your getting the bills paid and making financial and medical decisions? So those are the important decision makers. The key documents that you want to have: last will and testament, one that you write, not the state of Alabama. And so husband and wife each need to have a last will and testament. They'll typically be mirrors of each other, what we call a mirror, meaning they basically say the same thing. They just swap out the names. A document that we use often is a revocable living trust. It is not a tax planning tool, but it is a probate avoidance tool. Probate is not that expensive or onerous in Alabama. It is in other states, but it is also not private. So if you want your will to not be Google searchable to see how much you have and who you left your money to, revocable trust is a great tool for that, for organizing your assets, holding them, and keeping that private. It's also a good bridge. We were just talking a minute ago about incapacity. If you're incapacitated, but you're still alive, your revocable trust can still function, and it will have a succession of trustees that can manage things for you if you're unable to manage them yourself. So it's a very useful tool. Again, we talked a minute ago about a financial power of attorney. That's the person who can make financial decisions for you, pay bills, file tax returns, do all of that. That's typically your spouse, but you want to have some people behind your spouse as a backup. And then all the documents you need for making medical decisions if you can't make them on your own: your medical power of attorney, your state-drawn healthcare directives, the HIPAA waivers so that the doctors and hospitals will talk to your agent. And again, I told you I was going to harp on this, looking at asset titling and beneficiary designations. A couple of other things that we try and encourage clients to think about once they get through all of the above items is maybe adding a letter of final instruction. This isn't something that you'd want to put in your will, like I want to be buried here, I want these songs sung at my service, things like that. Obviously, that just makes it easier for your family members to put that plan together. A vital documents locator. This is incredibly important, especially now that so many financial institutions are forcing us to take documents electronically. We're not getting paper statements as often anymore. And so when you're your executor or your surviving spouse is trying to pull together a list of the assets and liabilities, it may be hard if there are no paper documents. So trying to keep an updated balance sheet, trying to keep your file system pretty current of what your assets are, recent statements, life insurance policies, beneficiary designations. And then for years now, we've been having to plan more and more for digital assets. So having a list of usernames and passwords, and you guys know that is hard. I mean, the list has got to be so long now of all the logins that we have. You throw in all the social media stuff as well. This is a difficult one, and I really don't know any other way around it than just trying to keep a list of that. Some companies, I'm not a big Facebook user, but I do know that they now have a provision that you can name somebody as the successor manager of your Facebook account if you die. And so I'm sure a lot of other places are doing that, or social media sites are doing that as well. But that's another asset to be thinking about. Okay, Jane's moved on to the really busy slide. Bear with me on this one. This one is busy. It gets into the weeds a little bit, but what I want to show is the concept of how things move through either probate or outside of probate or outside of your estate, depending on what you have set up as your plan. So this is kind of what a traditional plan looks like for us, for a client, once we've helped them get through it. So you've got a will, and in this case, if you look over in that probate column, we're saying one spouse has died. So you've got the spouse's will, and if there are any specific bequests, like, you know, you may say, give my motorcycle to my nephew, give my diamond ring to my daughter. But outside of that, you typically, there'll be a provision that says the residue goes here. And here may be to to group and to go into trust or outright to your beneficiaries. It may pour through a revocable trust. Again, that's not a tax planning tool. It's really a catch-all. But the first level of planning that we'll do with most clients is we want to utilize their estate exemption. So that, for simplicity, I'm going to say an $11.5 million. Under the will, we would first say fund that bypass trust. That's kind of, there's a couple of different ways you'll hear attorneys reference this: bypass trust, family trust, credit shelter trust. Those all mean the same thing. It's a trust that's meant to capture that estate tax exemption. And so we want to fill up that bucket first as much as possible. The way you fill it up is by having assets separately in that person's name who died, so that there's something to put in there. And then you do your catch-all that says anything that I can't put in the bypass trust goes to the marital trust. Marital trust may pay outright to the spouse, or it may stay in trust for the spouse. But you're basically saying, whatever I can't put in the bypassed trust to use my estate tax exemption, I want to use my unlimited marital exemption for the rest, or deduction for the rest of that, so that there is no estate tax due at the first death. I mean, that is typically always the plan. There are exceptions to that, but 99% of the time, that is the plan that we'll put in place, is to avoid any estate taxes at the first death. That bypass trust, the one that's holding that exempt amount of assets, is there to provide income to the spouse. You can add the children as beneficiaries if you want, through distributions of income, distributions of principal, for very broad standards of care. So absolutely pretty much at full use of that surviving spouse, but it does have that trust umbrella on there. And then you also get to make sure that those assets go where you say they're going to go. So, you know, you do have situations where people remarry later in life, and you want to make sure that the assets that you originally as a family put together go where you wanted them to go, maybe not to a new spouse. So that's the basics of planning at the first step. Fund the bypassed or exempt trust as much as possible. Any residue go over to the marital trust. And then at the second death, that survivor's assets will combine, and either those assets, depending on what you've said in your document, are going to go outright to your beneficiaries. They may go in trust for your beneficiaries for a set period of time, or Sheri's favorite, utilize that generation skipping provision and keep those assets in trust and protect them for those beneficiaries, and potentially for many generations down the line, through using your generation skipping exemption. And that allows those assets. So for example, if you left those assets to your children outright, not only are they available for their creditors or any dumb mistakes that they might make, they wouldn't do that, of course not, just kidding. But at their death, it's now stacked in their estate. And so if they've been financially successful and they have a taxable estate on their own, well, you just added to their taxable estate. But if it's in a trust for them, that's a generation skipping trust where they have access to the income principal if they need it, it's not includable in their estate, and therefore it gets down to the grandchildren and potentially future generations, and it's missed being hit by that tax funnel again. So fantastic tool. That's the assets that are part of your probate estate. Your non-probate estate, and don't get confused by this, this does not mean these assets are not taxable. Your taxable estate is going to include your probate estate and your non-probate estate. So non-probate is not a way to avoid taxes. It's just a way to avoid probate, which again, I said, it's not a huge deal in Alabama. It's not particularly expensive or cumbersome. There are reasons to avoid probate, but taxes is not one of them. So a non-probate asset would be property that you hold jointly with anybody, typically your spouse, life insurance that you own that you've named a spouse or somebody else as a beneficiary, and retirement plan assets where you have a beneficiary. So those are your biggest non-probate assets, and they're going to go according to that beneficiary designation or title. So let's say you have a big IRA rollover, a couple $1 million, you name your spouse as the beneficiary and you die. So now your spouse owns that IRA and can do anything they want with it. They can spend it all, they can accumulate it, they'll be subject to required minimum distributions. They can name whoever they want as the beneficiary. So there's no, you don't really control that. And so that's just something to keep in mind. How much control do you want? You can have more control. It's just going to require a lot more planning. And then you also have to weigh some of the income tax considerations. But understand that that is still part of your overall taxable estate. It can eat up your estate exemption, but it won't be controlled under your will. And then there are things that we will intentionally have outside of your estate. For clients,
you had a question for me.
especially when the estate exemption was lower, we, as a routine matter, would have clients get their life insurance out of their estate. That was a waste of using their exemption. And so either by buying life insurance in an irrevocable life insurance trust or transferring and waiting for that transfer, you had to wait 3 years before that transfer was effective for estate tax planning purposes. But moving insurance into an irrevocable trust would be a way to get that outside of your estate and not waste your exemption. It's still a great strategy. Honestly, why would you ever? Because let's say I own life insurance, I'm never going to benefit from that. So why do I want that in my taxable estate, right? So if I put that in a trust for my beneficiaries, that's just outside of my estate, and my trust will say how that asset passes down to my children, grandchildren, whoever it is I want to do that. You can also do that by setting up trusts that are outside of your estate, by permanently and irrevocably giving away an asset, which sometimes, that's not always easier said than done. But that is another way where you can have assets outside of your estate. So using those annual gift exclusions to either just give assets to your children outside of your estate and then that's now assets that you've moved off your balance sheet, or by making contributions to a trust for their benefit is another way of doing that. So that's kind of the big picture of what a traditional plan looks like. And I want to talk about next, I said I would come back to that concept of portability, and I promise this is the last super busy slide. But it's an important concept. So like I said, portability simplified planning and made it easier to not worry about wasting an exemption on the front end. So on the left side where you look at electing portability, in this example, we've got a $15 million estate, and on the first to die, you file, you do have to make this election through the Form 706, where you elect to port that exemption that wasn't used to the surviving spouse. So In this case, you know, the assets are just transferred to the surviving spouse. We didn't really do any planning other than to elect portability. And at the second spouse dies, their death, the estate, just for simplicity, we kept it at $15 million. So the portability was elected for the first spouse at the $11.5 million. The second spouse has their own exemption. Let's just say for simplicity, it's still at $11.5 million. No estate taxes due, right? So yeah, great. Why would I want to plan anything, you know, different than that? Well, look on the right-hand side, and I'll explain why. So if at the first death, instead of relying on portability, we made sure there were enough assets in that first spouse to die's name to fully fund their bypass trust. So you go ahead and transfer the $11.5 million into a bypass trust that benefits the surviving spouse and children. They can have income, principal distribution, whatever they need. And the balance over that, so in this case, everything was in the first to die spouse's name. We used the marital deduction to get the other $3.4 million to the second spouse, either outright or in trust, doesn't really matter there. So the second spouse dies, and if it happens within a year of the first spouse, you're not a whole lot of leverage in having done this. Where the leverage comes in is if there's a significant amount of time between the first death and the second death. So that $11.5 million, it can grow, right? So let's assume you invest that in stocks and bonds and you get a 5 to 6% return conservatively over a 20-year period of time. And let's say the spouse has taken some income off of that, but they haven't really dipped that much into principal. Well, 20 years later, that $11.5 million could be $30 million, right? I mean, that is compounding growth over time. And when that passes down to the next generation, there's no estate tax due. You've already got it in the estate tax-free funnel. And so what you're getting with going ahead and funding that bypass trust at the first death is tax-free growth of that principal. It's not to say that there's not some income tax due. It would be just like, you know, if you have a brokerage account with stocks and bonds, you've got interest and dividends. Sure, you've got interest and dividends being kicked off that trust. You can manage that by how you manage the investment assets, obviously. But what that principal grows to is tax-free to your beneficiary. So there's a ton of leverage in going ahead and funding that bypass trust at that first death. If you solely rely on portability, there's no growth in that portability number. The $11.5 million stays static. So time value of money, right? $11.5 million today is not the same as $11.5 million in the future. So if you wait on using portability in the future, that's not worth as much as using it today. So I hope I explained that well. If there's a lot of questions on that, we'll pick them up on the question and answer section. Okay, so what I want to talk about next is, so we've got our basic traditional plan in place, and now we can look at layering on some charitable strategies to this, whether that's during lifetime or at death or a combination. So just a quick refresher on the income tax deduction. Your income tax deduction for charitable gifts is not unlimited. So for most gifts of cash or appreciated assets, appreciated stocks, bonds, it's limited to 50% of your adjusted gross income. If you go over that, you can carry that over for some period of time. And there's some more complicated rules that apply for assets that are not marketable securities or short-term gain property. But the majority of gifts that people make are going to be cash, stocks, bonds, real estate, that kind of stuff, things that would qualify for the more favorable treatment. Rules for 2020, there's a little bit of difference in that you can make a gift of 100% of your adjusted gross income when using cash or securities. And for those who don't itemize, which is more of us now with the standard deduction being as high as it is, there's a little bonus of $300 deduction for those who don't itemize. Just a quick example of this one is a great technique to use of giving appreciated assets versus cash. So I've got a simple example here of giving cash versus giving Apple shares. We had to update this. We'd done a slide like this several years ago, and Apple shares have gone up so much. We had to reduce it down to 10 shares of Apple to be worth $5,000. My clients who've held Apple for a long time have a great asset to give for charitable gifts because it's got a tremendous amount of built-in long-term capital gains. So the decision is do you give cash or do you give appreciated securities? Cash obviously there's less leverage there because you've paid the income tax on that. If you had to convert some Apple stock to give to charity, you'd have that built-in capital gain that you have to pay. But the way the deduction works, if you're able to get the deduction, if you're itemizing, is that it's the fair market value. So under both scenarios, the gift of $5,000, the charitable gift is $5,000, but the tax savings is so much more on giving the appreciated Apple stock because you don't have to pay the capital gain. Even though your basis is $500, if it's worth $5,000, that's the charitable deduction. So there's obviously a lot of leverage in that. And with the run up in the market, even though we had quite the downturn in March and April, we've had quite the run up since then. And I have lots of clients with big built-in gains that we can use for these kinds of gifts. Next. Real estate is another asset that either is a gift that someone gives during their lifetime or at death. But again, that one gets the same treatment. You know, if you sell a piece of property, you've got capital gains on that when it's sold. There's some offsets if it's a residence, but if it's, you know, investment property, it's just a pure capital gain asset. And so if you're giving that, again, you can avoid the capital gains on that. And then the charity would sell that piece of real estate and use it for good purposes. We know that. This one is my favorite though, for what it's called a qualified charitable distribution. And I forgot to look at what year this first came out, but it was always kind of temporary until now it's permanent. But remember, nothing is permanent. But I love this one, and I hope this one never gets taken away from us. This is a fantastic charitable giving strategy. So as you know, when you have retirement accounts, you've been contributing to those. They've been growing tax deferred for many, many years. And it used to be 70 and a half, but now it's age 72. You have to start taking required minimum distributions from those accounts. Although that's temporarily waived for 2020. We do expect that to come back, and then we'll be making required minimum distributions again. A qualified charitable distribution comes directly from your IRA to a qualified charity. So you don't take the cash, put it in your bank account, and write a check to charity. You've got to arrange with the custodian for that distribution to go directly to charity. So you either call them up, ask them to make a check, or you ask for check writing on your IRA so that you can make that a direct gift to a charity. It can satisfy your required minimum distribution. It can be more than your required minimum distribution. It can be less than your required minimum distribution, but you are limited to $100,000 a year as an individual. If you're married and you each have your own retirement plan assets, you can each do $100,000 for a total of $200,000. There's so many benefits to this. The biggest one is that it's not in your taxable income. Let's walk through the example, and then I'll talk about why that's so important. So in this case, our clients are comfortable living on their Social Security and their investment income. Their required minimum distribution is $30,000, but they want to give $10,000 to charity every year. So their options are to give $10,000 out of cash after they receive their required minimum distribution, or make that direct charitable gift to the charity for $10,000 and take the difference, the $20,000 in ordinary income for them. the next slide walks through the tax. You got to make a whole bunch of assumptions about what their tax rate is and, you know, standard deduction or itemized. But, you know, if you just look at not putting that in ordinary income, if you remember how the front page of your federal 10 form 40 looks, you're listing all sorts of income, right? And the bottom line, the last line on there is your adjusted gross income. The lower that number is, the better for all kinds of things. So the cool thing about the qualified charitable distribution is it never hits page 1 of your tax return. It never is considered in the calculation for income tax. You don't get a charitable deduction. Let's, you know, forget this high standard deduction. Let's say it was back to years ago where everyone was able to take an itemized deduction. You don't get an itemized deduction for this, but it's better for it not to be an income in the first place, because when you're itemizing, you're not getting the full $10,000 deduction, right, for what that charitable gift is. You're still running through the tax funnel, so it's not a dollar for dollar offset. But if it's never been in your adjusted gross income to begin with, your taxes are obviously way lower, but it also helps with other things. There are a lot of taxes or trigger points that are based on adjusted gross income, Medicare premiums being one of them. I mean, that's an important one. Another one for very high income earners, maybe some of the additional taxes that are out there that stack upon the basic taxes. So AGI is a key number, and keeping it low is obviously a tremendous benefit. So I've really enjoyed helping clients learn about this, take advantage of this. It's a great way for clients to use their IRAs for charitable purposes. And again, this is an asset that's got a whole bunch of tax liability built into it, that the only way you ever get out of paying it is by giving it to charity. You got income taxes and estate taxes. They're just waiting to be assessed against this asset unless it goes to charity. So that avoids all the taxes. Okay, I hope I made that one clear again. Like I said, it's a great technique. It's an easy technique, and I think it's going to be here with us for a while. In the last few minutes that we have, and I better pick up the pace, we're going to talk about a more complicated charitable remainder trust technique. We're going to talk about charitable remainder trust and then briefly cover charitable lead trust and then just outright gifts in your will. A charitable remainder trust, UAB has received many of these over the years, but Kimberly in a recent newsletter highlighted a cancer survivor who's 15 years cancer-free, who's just made a gift of a charitable remainder trust to UAB, and he did it in conjunction with the sale of his business. So big tax year, big tax liability built into that. So that's one thing that you may look for. You may have a whole bunch of Apple stock or stock similar to that, where you've got a ton of appreciation, and in order to sell those and get a income stream distributed out of that would cost you a lot in capital gains. So a charitable remainder trust makes sense when you have a big taxable year, you've got capital gain assets, you're looking to get a charitable income tax deduction in the current year because it's tied with a big income year, and you're also looking to reduce your exposure to estate taxes, and you've got a charity in mind that you want to benefit. So those are some of the key things that you would look at. Let's look at an example real quick of how it works. So you are the grantor, and one of the first decisions that you have to make is how much are you going to give and what form of income are you going to take back. There are two ways to set up the income back to you. So you're going to give the asset away and you're going to take back an income stream. A charitable remainder annuity trust means you're going to get a fixed payment. So if it's $1 million and you say, I'm going to set it at a 5% initially, but I'm going to make that a static payment, you get $50,000 a year for as long as you live. You can set it up for a joint life for you and your spouse. You both get that amount for as long as you live, and whatever is left goes to charity. Or you can set it up as what's called a unit trust and that is where you're doing a fixed percent. And again, that 5% may be the amount you set. So you may start out year one at 50,000, but the unit trust payment gives you the opportunity to have an increase in your income over your lifetime. Okay. So you're investing those assets that are in the charitable remainder trust. You revalue it once a year and recalculate what your 5% payout is. So stocks generally go up more than they go down. So most times you're getting an increase in the payment that comes to you over your lifetime. There is a tax deferral on, you get the charitable contribution going in, and there's a complicated tax structure, but you can manage that to where it's a very favorable tax outcome for the income tax portion of that. In our calculation here, it all depends on how old you are, how, if you set it for your life expectancies, then we're going to have to use some life expectancy tables to come back and figure out what the charitable deduction was. In this scenario, the $1 million gift resulted in a current year tax deduction of just under $450,000. And so that deduction gets used in that year or can be carried forward if you aren't able to use it all in that year. I think the next slide has a little bit of the inputs in it. The grantor's age was 65. It was done for life. We assumed a 7% growth of the trust and payout of 5%. And based on life expectancy tables, that's where you come up with the deduction amount. So what you take for a charitable deduction. Okay, real quickly, we'll talk about charitable lead trust. This is kind of the flip side. It's basically the same concept, but the charity is the one who gets the money first, and the remainder goes to your beneficiaries. This is something the Kennedys used. This has been around for a long time. Both of these techniques they're not risky in how you set them up. These are long-term strategies that people have used. So it's basically the opposite. Let's flip to the graph to kind of walk through that. Same amount, $1 million, same decision. Is the charity going to get a set amount, or are they going to get a percent every year? And then the income tax deduction is calculated. It's a little bit more favorable in this one because the charity is the lead. Depends on how many years you set that for. You can set that for a set number of years or for your lifetime. But then what's remaining at the end, when the grantor dies, the charity stops being the beneficiary, and whoever you set, typically family members, get the remainder. And we've already dealt with all the taxes, so there's no tax on that. If you want to look at the input page, let's see, on the next slide, Jane. Yeah, so same situation. The grantor was 65. It was set for their life. It was $1 million gift, and the deduction was larger this time because the charity was on the front end of that, $700,000. You know, if you're looking at what you're looking at leverage on that, obviously you're going to try and grow the principal of that while the charity is taking a distribution. Ideally, that principal is actually really growing in that, so your beneficiaries are left with a nice asset. One last thing before we go to questions. You know, one thing that all of us can do, some of these techniques, the charitable remainder and charitable lead trust, may be for a larger estate. But one thing all of us can do is just make a simple gift out of our will. You know, many of my clients are big tithers in their lifetime. They're making annual gifts to their church or their favorite charities. And you can do that same thing under your will. You can name a dollar amount. You can say, I'd like 10% of my estate. You can list a bunch of charities. You can, name one favorite charity. That's a great way to continue on your charitable legacy. And again, using retirement plan assets by beneficiary designation is one of the most leveraged things you can do, because whatever you leave to your beneficiaries, they've got income taxes, they've got estate taxes potentially that are built into those assets. But if you leave something to a charity through your retirement plan, they get that and there's no tax on that. So it's a great strategy. Phew, I talked a lot. I hope we have some questions out there.
Fantastic information that you've given us so far. We do have a few questions, and if anybody else has questions, we'll linger on for a little past 1 o'clock hour, but we do want to be respectful of everybody's time as well as Sheri. First question is paying for a daughter's wedding cost or a car considered a gift that's subject to limitations?
Yes, sort of, kind of it is. It's one of those things that it's a little harder to trace and track, but technically, yes. I'll leave it at that since we're being recorded.
So now, considering what happens with the election, has anything been said about the estate limit of $11.5 million per person?
I don't know of any specific proposals at this time, and obviously that's going to depend not only on the presidential election but the control of Congress. So hard to predict where that is going to go. I will say in my I think I'm on 30 years now, this is the most generous estate tax scheme I have seen. It's only gotten more favorable, really, my whole 30 years of practice. It's just gotten better and better. There occasionally are some proposals out there to limit things. There's a technique we didn't really talk about today, that a grantor trust that was kind of being abused and probably did need a little bit of reining in. But, it's a really generous estate structure right now. So if you are worried about potentially losing some exemption and can afford to go ahead and do some planning where you lock in that exemption, that high exemption amount now, that's always your best bet. We did that, and I'm going to forget what year that was. I think it might have been, it was either 2010 or 12 when we were at the cusp of potentially losing some estate tax higher exemption amounts. And I worked with a couple of clients to go ahead and make some gifts and go ahead and use that exemption. We ended up getting a higher exemption later on. So that was great. Now they've got more exemption they can play with. So that's one thing you could do, is go ahead and lock some gifting in now.
So out of everything you spoke about, obviously it was a lot of federal and then a lot of Alabama. Do most of the states have consistency with all of these rules, regulations that have to be followed with tax and all that?
Not really. Most of them will conform to the federal as far as the estate tax scheme, but state tax laws can be really squirrely. I know Alabama best because I've been practicing here my whole life, but I've got a contingent of clients in community property states that present some challenges that we don't have to deal with. But from the estate tax perspective, most of it's fairly consistent. There are just some weird nuances from state to state.
For the gift tax educational exemption, can you exempt tuition payments for your own children while they're dependents?
No. But it's not, you don't have to worry about that. That's just your obligation as a parent.
Good for us. Will you be able to take a standard deduction with the QCD?
Yes. Yeah. QCD never hits your tax return, right? It's just kind of like you got two sets of books here. It's off the books.
What advice do you have for someone that has a house and life insurance policy to pass on to their progeny?
As far as if you're not in a taxable estate, you can accomplish a lot of that if it's just one child, or if it's multiple children. I'm not sure. If it's more than one child, I would probably run it through probate estate. But if it's just one child, you can do some simpler things there where you're really avoiding it. You still will want a will. You'll still, want something very basic in there that's a catch-all for assets that you didn't know about, you forgot to plan around, and just some basic administrative things. But you can be pretty simple.
Since lawyers and accountants have different ideas of estates, do you need to get the two to help make these decisions?
We prefer to have a team approach with doing estate planning for clients, especially if you absolutely have to do that when you start getting into some of the more complex structures where you are using the charitable remainder trust or grantor trust, doing family limited partnerships. You're trying to layer on some techniques. If the planning is pretty basic, maybe that's not necessary, but I always like to keep everybody in the loop and involved just so they are aware of what's going on, even if they don't really have a role to play at that point.
Question before we let you get on with your day. If I am the last to die and my daughter's the beneficiary of my estate, are there state taxes due? And would those be for the state where they live or the state where the daughter currently lives?
Okay, being one who doesn't administer estates, I'm pretty sure it's going to be your state and most states have a uniform code where they're not really collecting estate taxes either. So she should be fine either way, but I'm pretty sure it's going to fall under Alabama. But yeah, that one's kind of, I'd punt that one back to an attorney.
Gotcha, Sheri. Thank you so much for joining us to discuss things we need to consider when putting an estate plan in place. Thank you so much.
Thank you. I enjoyed it.
So just a heads up to our guests, a recording of today's webinar will be available online tomorrow. Now with more information about the UAB Office of Planned Giving and how they can help you, I would like to turn things over just briefly to Kimberly once again. I know she's still there. She's going to have to mute herself.
Sorry, y'all. Technical difficulties, right? Sheri, thank you again for sharing your time and expertise with us today. You have set out a lot of food for thought for us to consider whether we're crafting our first estate plan or whether we're revisiting an existing plan. As we've mentioned, I serve as the Director of Plan Giving at UAB, and my role is to help facilitate estate gifts to the university. I'd like to spend just a moment today to really emphasize some of the points that Sheri made on the importance of including philanthropy as a piece of your estate plan. Legacy giving is a powerful tool to use to support the UAB programs that mean the most to you. Plan gifts can allow you to take advantage of legal and tax strategies so that those gifts best suit your unique situation and accomplish your personal and philanthropic goals. They're creative and they're flexible. If we've piqued your interest today about any of these giving techniques, or if you'd like to learn about how they could work for you, please don't hesitate to reach out to us. We'd love to have a conversation with you about that. Thank you.
Awesome. Thank you, Kimberly. Meanwhile, if our audience is looking for a podcast, we've got one. Check out the UAB Green and Told. Episodes drop every other week and feature members of the UAB community. You can listen in on Spotify, Stitcher, iTunes, or even go to our website, alumni.uab.edu/greenandtold. Next Thursday, we invite you to take part in our annual UAB Young Alumni Rising Star Awards. This event allows us to celebrate the accomplishments of up-and-coming young alumni. As always, you can register on our website, alumni.uab.edu. Also, interact with the UAB National Alumni Society on social media. We can be found at UAB Alumni on Facebook, Instagram, and Twitter. You can also look us up on LinkedIn, search UAB Alumni Career Community. And finally, if you want more information about us, visit us online, alumni.uab.edu, or just email alumni@uab.edu. Once again, thank you for joining us for today's discussion with Sheri Robinson. I hope you all have a great afternoon, and we hope to see you soon. And as always, go Blazers.